Go.
Hello, Don. How are you doing today?
I'm good, Pete. How are you?
I'm doing well. We're going to have our third session, and the session is going to be about financial planning, how it should be done. In the first two sessions, we try to demonstrate to you that the financial services industry is a sales operative type of field, and that it has very few credentials, and that you need to be very careful of the professionals even in the field. So today we're going to talk about financial planning, how it should be done, and how you can do it yourself, or if you hire someone, and we'll go through as to whom to hire, how that should be done. Should we go to the next slide?
So as a quick note then, so this is just our overview. The reason I wanted to start here was because really for this, let's see if we can make it go. No, don't want to do that. There. So if you're watching the video up in the upper right-hand corner, you already know how to get here because you're looking at the videos. But we wanted to make sure that we pointed out on the website, which is listed right here for itsyourmoneyandestate.org, you can go under workshops, It's Your Money, pick which one of the sessions you want, and there will be articles, the handout material, these videos, all of those will be posted on the site. And to us, that's real important for you to know in terms of where we are and where we're going. Where we are also is, as Pete had said, this is the first financial planning session, goals and assets, we'll talk about those. And then from here, the next one, the fourth week, we'll be planning in terms of investing your money. So let's go ahead and let me switch over to this one. And we're going to go up here, and we're going to go here. There you go.
Okay, the good news is I'm not Gina, so I'm Peter Kote.
You're darn right you don't look like that.
And she looks much better than I do.
Whoa.
Which brings us to an item that we have first introduced, and that was the Ask First form and a blank one. So I'm going to pretend that Gina is being interviewed right now, and that she has just completed this Ask First form that we really encourage you to use with anyone new that's going to be dealing with your money. And even if you've been dealing with somebody for a long time with your money and you don't know the answers to these questions, this takes a professional approximately about 10 minutes or less to complete. And this is kind of the minimum that you ought to know. When I've asked individuals in the financial services industry about why have you chosen this particular individual, the number one answer has always been because they're such a nice person. And if you're in sales, I don't think you'd be very good at selling anything unless you were nice. So nice is important, but as we will go through this, some of the other things are more important. First of all, education.
She has a master's degree.
She has a master's degree. All right, and the master's degree is a master's of business administration with a concentration in finance. So if you're going to be in the financial planning area, that's a pretty good background in education to have. Don, what did you get your degree in?
Undergraduate degree was accounting and statistics, and master's of business administration in international affairs.
Ah, and did you have any?
We're not going there. Maybe I should change that to international business.
Back
to Gina, yes. Coming back up.
But I think it's more important than just the degree as the number of years experience. So she's had 30 years experience as a CPA, including 12 years experience as a fee-only fiduciary registered investment advisor. So we'll talk a little bit more about that, but that 12 years of that experience is, for me, is what I'm looking for if I were to look for someone in the field. License type, relevant licenses. You know, it's kind of like if you are going to cut hair and be a barber, you have to have a barber's license. If you're going to drive, you have to have a driver's license. People get confused a lot of times when they're looking at a professional as to the difference between a credential and a license. A registered investment advisor is a registration. It allows her to give investment advice, and it's issued by FINRA, but through the California Securities Regulatory Division. And the reason for that is that she has under $100 million in assets under management. I believe she said somewhere around 80.
Correct. Yes, she did. Yes, she did.
Okay. Everything in the financial services industry is about full disclosure. So the registered investment advisor designation, you can go online on BrokerCheck with that license number, look her up, and it'll tell you exactly where she's worked, whether or not she's had any disclosures, etc. She also keeps her CPA designation, and that CPA designation means that she could do public accounting and tax planning. It's issued by the state of California. There's her license number. And again, she's regulated by the state. And the state has, again, a public website where you can go to see whether or not an individual has been disbarred, is continued to be a license, etc. I recommend highly that you check up on licenses.
One of the important parts also that I want to add is she is also a personal financial specialist, a PFS, which is a subset within a CPA license. So her specialty is as a professional financial specialist, also has to be a fiduciary relationship because of the CPA license. Absolutely has to be fiduciary, but it's a subset within that. And so that is not only does she have the CPA, she's gone beyond that in training to also become a PFS.
Okay, but it's really important to CPAs are the most. It's the most trusted designation in the country.
That's why I have my CPA.
Yeah, so people can trust you, and it's a good thing because most of these CPAs are honorable, but there are a few who are not. And so if a CPA has additional licenses besides their CPA, whether securities licensed, i.e. a Series 7, a Series 6, or an insurance license, you know, then your A antenna ought to go up and a B antenna got to go up. I actually said not your B antenna, your S antenna. So be careful, okay? People don't have licenses just to have licenses. Let's go, she does not practice law, although she does review the estate planning portion of your estate. She has a business relationship. Well, she will serve as a fiduciary and serve your interests before she serves her own. Compensation. From my point of view, compensation is literally the most important. How is she paid? She's paid on an hourly basis, fee only, no commissions, no product sales. Her hourly fee is $250 an hour, and she charges an assets under management fee, which is 1.25% on the first 1 million, declines after that. The second box, it says payment will be made by, and it says the client. So if the client pays her, who is she obligated to? You, the client. If she were to work for Merrill Lynch, for example, then the payment would be made by Merrill Lynch to her. Who would she have a fiduciary an obligation to? Merrill Lynch. So that's why it's a little bit subtle as to how the payment is made. She's not right under that. She's not associated with anyone who sells annuities, insurance, mutual funds, or financial products.
One of the things, I want to take us back up slightly to fee. She had also said, so her minimum of clients that she takes on is $1 million under investment. There is a question made of, so her fee is 1.25, starts at 1.25% of assets under management. Is there an additional fee? Because she doesn't hold the assets. She either uses, as I recall, Schwab or TD Ameritrade. There is a holding fee, not a large fee, because she doesn't buy and sell stocks. She doesn't have any reason to do this. It's here's the plan, here's where we're going to go. But the money is held by a brokerage firm, which is a good thing because now you have them segregated from that individual. So there was a question of whether or not there was an added fee. It's a very small fee, and I think initially there is no fee at all.
Do you remember Bernie Madoff?
Yeah.
Yeah, what a name, huh? Madoff. He used his own firm as a custodian. So custodians are where the money is held. So Gina uses Schwab or TD Ameritrade to be the custodian of your money. And your statements come from a completely independent source that she has no control over. The only thing that she has control over is through a power of attorney that says that she can make trades in your account and that she can pay herself her agreed upon fee with you. So always make sure that the financial advisor that you work with has a custodian that's separate and apart from themselves.
So in my case, for instance, I have a brokerage house, an investment group that I work with, but they have a separate custodian. I get two statements, one from the custodian, one from the investment advisors, and I check to make certain that they balance to each other, they tie to each other, because that way I know where the money is.
Correct. And there's no financial tie between the custodian and the financial advisor, completely independent. Financial products and affiliated organizations, she has none. Right. And then she signs under penalty of perjury. This is language that needs to be used in order to be used in court if anything above is incorrect. Okay. My biggest thing is what I see people is, on our business relationship is that 90% of the individuals in the financial services industry or more would have to put false on that. Would you really want to do business with somebody who can't really state that they put your interest first? Anyway, let's go on to the next. Just a quick review.
She's the president of Clarity Wealth Management. They are not affiliated with the broker. They act for the client's behalf. No product sales ever. There's only fee related in terms of what they do. They will charge a fee if you say, I want to have you do a plan. There's no investing or everything else, but that's where she will charge you an hourly. Otherwise, it's based on assets under management. We were talking before about CPA and PFS. So in her case, she has a normal full certification, AICPA license or certification from the exam standpoint. She had to do specific number of years of experience before she could then say she was also in that subsection. She has to maintain her license to do that, continuing ed requirement, the exam that they had to do 40 hours a year. One of the important ones is the conflict disclosure. There cannot be a material conflict existing between Gina and her clients. She's not allowed to have one. She can't say, oh, this is a conflict. Here, I'm going to give you a piece of paper that tells you. She cannot have one, period. And that's a distinction between a PFS and a CFP. And we'll get to that in just a minute. But in her case, she has to act because of the CPA first and then the PFS in the client's best interest. As opposed to a CFS, go ahead, Pete.
Yeah, why is this important? And it's important because according to the National Association of Securities Dealers, NASD, is that there are 125 to 150 designations in the financial services industry. Most of them are just bogus, and people don't even know what they mean, and they're literally purchased. The sad fact is that if you watch all 8-week sessions, you will have sat down and learned more about money than most brokers within the industry. So that's why this is important, that you know what the designation is and what did they do to earn it, because they all want to sound really good. Let's go to the next slide.
We did. So CFP, the difference is, in this case, it is not tied to a CPA. It is a separate organization that awards this. They have an exam that they have to take, bachelor's degree, they've had experience, 30 years of continuing education a year. But in this case, they are allowed to have a conflict of interest if they notify their client in writing. Client doesn't have to accept it, but they have to tell them in writing. We're back to the legal issues here, that they are allowed to have a conflict, but they have to tell you if they do. Where on a PFS, they are not allowed to have the conflict of interest.
Yeah, and there's also, the certified financial planner has become the best known in the industry. And so,
they advertise on TV.
Yes. And so they're trying to upgrade the standards within the industry itself. So my hat is off to the certified financial planner. It's a 2-day exam. And again, let's say you have an MD, somebody who has their medical degree. Does that mean that they cannot sell product? Yes, they can. Same thing with the CFP as well. So you do want to ask, how are you compensated? And if they're compensated any which way by sales, then they are in the sales field, not in a professional financial planning area.
So then the third one, as Pete answers his phone, is the chartered financial analyst. Again, that's an organization that goes through. You need work experience, professional ed. There's a series of exams that they have to take, and they are not required to act as a fiduciary.
What they do, CFA is people who have the CFA designation. It's very equivalent to the CPA. It's one of the toughest designations to achieve, and most of them work for mutual funds. What they teach you is how to analyze a particular company, how to look at the balance sheet, how to review the prospectus. I mean, it's a very rigorous course. And the way I say the difference between a CFA and a PFS and a CFP is that a CFA takes a 5-inch wide area and goes a mile deep into that investment. Whereas a PFS or a CFP,
alphabet soup, yes.
And I haven't even had a glass of wine yet.
That's too bad.
Theirs is about a mile wide, and they don't go but 2 to 3 inches deep in any one particular area. So when most people think about a financial advisor, the first thing that comes to mind is, what are you going to invest my money in? And as you'll see through this financial planning process, that's the apple falling off the cart. Let's go to next.
So we're going to talk about who is a financial planner and then what is financial planning. So, Pete had talked about a lot of these different titles that are going to come into play here in terms of what all they're looking at.
You can call yourself anything you want. You can, after we get through this, Don, we can give all the attendees a certificate saying a money advisor extraordinaire. There's no nothing illegal about naming yourself whatever you want to call yourself.
Go ahead.
Financial planners. Just another name that's really abused. It can mean to anything. Usually it means that somebody is a registered investment advisor, broker-dealer. Broker-dealer is a Merrill Lynch, is a UBS, Ameriprise. It's a person who acts as a middle individual related to real estate. Coldwell Banker, First Team. They're broker-dealers within the real estate area. Banks, many of them are affiliated with broker-dealers. Schwab has its own bank, for example. I think Bank of America has its own
As Merrill Lynch.
Yeah, Merrill Lynch. Insurance companies, trust companies, the same thing. It's everybody wants your money, okay? And so
speaking of money, let's follow the money.
Yeah, various methods. Number one method, the oldest method, is commission. That was the old stockbroker. Probably about 40% of individuals still are in the financial services industry completely on commission. Fee-based and fee plus commission are kind of interchangeable. When somebody tells me they're fee-based, that means they could charge you a fee and also earn a commission on selling you a particular product. So when I hear fee-based, I say run for the hills. What you want to look for is a fee-only advisor, that they don't receive any other compensation other than a fee. And it could be on an hourly basis. And by the way, hourly basis, there's only about 2 or 3 fee-only advisors here in Orange County that work on an hourly basis, so it's not real common. Fee-based on assets under management, it's basically AUM, and the average is 1%. So, and some financial advisors have a minimum, like Gina has $1 million minimum, but there are advisors who have no minimums. And the process that we're going to talk about is the same, whether you have a $10 million estate or whether you have a $200,000 estate. It's probably easier to plan for a $10 million estate than it is for a smaller one.
And Pete, from the fee-based on assets under management, typically as your portfolio grows, the percent they're taking will decrease. So Gina's at 1.25% at the $1 million, but as a higher level, I would assume she would lower down that percentage because it's against a larger number.
Yeah, and the hope is that that as your portfolio grows, her compensation, you're on the same side. Retainer. Retainer is a kind of a unique way of getting paid, but it's for individuals that I see that have a lot of real estate or partnerships. Their stocks and bonds are easy to value on a day-to-day basis, and therefore your fee is based on a percentage. A retainer is sometimes based on a value of some assets, but it's hard to say how much that value is worth and also how much work goes into it. So retainer is just a unique agreement that you have with your financial advisor as to how that they're paid. Whatever you do, it needs to be in writing. Now I'm scared. How do I select my financial planner? You go to Vanguard, do it yourself. It's not a bad idea, okay? Not everybody needs a financial planner, but if you're scared and confused, then there's no reason for you not to have a financial advisor, i.e., I can't fix my own plumbing. I don't build my own house. Same thing. I don't manage my own money just because I don't have time to do that. I have the skill to do it, but I don't have the time or the desire. So I hire a financial planner to manage my money for me.
And also, and one of the key things, and part of what we'll go through today, and as well as the next session, is what's the plan? Because you can say, well, I want to manage my investments. Manage it to what? What's the plan? What are you trying to accomplish? Where are you trying to go? And how are you going to measure it? That's a big part of this. And the key, we'll harp on it a lot over the whole time, is fiduciary relationship. Not registered with a broker, not connected to, well, this is the best thing we need to sell this week. It's a matter of this is what you're doing. And as we have said, holding the investments under an independent custodian, the expertise, the rapport and the trust, the relationship that you have with them.
Yeah, and you know, being nice, that's where the rapport and trust comes in. But see how it's listed last, you know, that you understand the designation, that you understand how the person is paid, you know where your money is being held at, how much experience that the person has. And then again, it's really important to have that rapport because they're talking about your money. So we always recommend meet with at least 3 individuals, and then and all of the fee-only advisors will give you a free hour and a half, and initially, because the hope is that that you're going to stay with them for a very long time.
And it's going to be a good fit.
Yeah, and you know, this is another thing. The experienced broker has between 3,000 to 5,000 clients. 3,000 to 5,000 clients. I'm talking an experienced broker. An experienced financial advisor, at most 125 clients.
Gina said she has $80 million under management. If her minimum is 1, then at most she must have 80. And
Yeah.
so my guess is she's well under 80 because she has other clients who are bigger.
Yeah.
The other thing that comes up, and a lot of times when we go through this, is the issue of, for non-fiduciary, is the suitability. And a broker can say, this is suitable for you, and that's fine. That's all they have to say. But is it in fact in your best interest? And that's from the fiduciary side. So that's the difference. And we talk a lot about how are you paid. If you're a broker working for Merrill Lynch, who for some reason we keep picking on, you know, they're getting the trip to Hawaii. They're getting whatever the other incentives are for selling a particular kind. And it can well be suitable. Well, you know, at your age, this might be okay for you, but it doesn't mean it's okay for you as an individual. That's the fiduciary side.
Okay, remember though that most attorneys, most CPAs, even most brokers don't even understand the term fiduciary and don't understand the difference between a broker and a fiduciary investment advisor. So the fiduciary is kind of the F word in the financial services industry. Let's go to the next slide.
So just pointing it out again, from Gina's standpoint, not affiliated with a broker. We've talked about the other points in here. So basically what we're going to do now, you know, where do we want to go and what's the plan? What gets us going from a SMART goal standpoint, question and answers. And then next week, we'll get into more of how you choose this, how you decide what investments you want to do and where you want to go. Part of this is because using a planner, and Pete was somewhat cavalier saying, well, just call Vanguard and do it yourself, except that statistically, a good fee-based advisor is probably going to help you get a bigger return. That may also make you stop from doing knee-jerk reactions. Oh my God, the market's going down, I have to sell. No, do you have a plan? How are we doing against the plan? And that's one of the big things in investing.
Yeah, one of the calls that I get the most from individuals is being unsure about making a financial decision and not knowing who to call for financial advice. And so especially as you get older, you know, you're not, it's not that you're forgetful. It's not that you're not interested. It's other things are taking up your time and interest. And so having somebody that you can turn to and call for, should I be doing this? Should I give my son or daughter some money? Should I save some more money for my grandchildren? Can I live comfortably spending this for the rest of my life? And we'll get into some of those goals, but having somebody you trust allows you to live a lot more comfortably.
And a lot of that comes down into what's the process that we're going to go through. So as Gina lays it out in terms of the process that certainly she uses, goals and assumptions, cash flow, what's your income, what's your expense, tax planning, because that's a big thing today and later, retirement planning, in this case, generally we're all retired about now, education planning for grandkids, whoever it happens to be. Big thing is in terms of risk management, insurance, how do you cover those kinds of things, estate planning, investment, and then miscellaneous ones for different situations. One of the things that she does is basically go through sort of this question group of what's important to you about money, 5 years from now, where do you want to be? A month from now, what do you want to be? And one that she particularly likes is, what do you want your tombstone to say about you?
What would you want them to say, Don?
There he is.
Here he is. Is that
Yep,
it?
that's enough. And it should be a small tombstone since it's, never mind, we're not going there. Okay, so where are we now? And that's one of the big things with this is what's important in terms of relationships that you have, be it a spouse, significant others, kids, grandkids, siblings, whoever it is. She makes a big point on the fact that pets cannot actually have inheritance because they are an asset. They are not actually a person. However, you can set up a trust in such a way that the pet is taken care of. So we don't mean to belittle pets at this point. But one of the key things that she really focuses on and is critically important is you have to think about yourself first. I mean, Pete likes to talk about it. First of all, the class is called It's Your Money. It isn't their money. And therefore, let's pay attention to what we need as opposed to what they may want us to do or what they want us to believe.
Yeah, and the nice thing about if you take care of yourself first and you take care of yourself well, that sets an example for others to follow. So I love this. Are you smart?
Yeah. What goals got to be specific, have to be measurable, have to have an action plan, realistic, and what's your time limit? You can't just say, oh, gee, sometime in the future. Because if you don't do these things, simple as it sounds, you're just wandering around doing something else.
Yeah, it's I see it all the time. So and you have to, and these are not easy things to. Sorry about that. These are not. I think this is where having somebody to talk to who has been through this with other people really helps you out, because you can't have 20 goals. You pick out, maybe you put down 15, and then you evaluate your top 3, and then you ask, well, how do I measure a goal, and what is this action plan all about? And having somebody else there who's a financial advisor can tell you, is it realistic or not?
And a lot of it also is then having structure. I mean, let's formulate the goals. What are these? You as an individual, spouse, partner, whatever it happens to be, what's the best case, worst case? Because you can say, gee, I want to have such and such. Is that in any way realistic? What if you have other issues, health issues, other things going on? What's going to occur? And then rank and prioritize those goals. Pete's goal sort of relates into this one of wanting to have money so that he can travel nicely. But again, it's a certain dollar amount, certain time period, and a certain carry part around it. And incidentally, I want to be able to leave this to my kids. Now, the question is, can you do these things? But that's where a specific action item of, this is what I want to do. That's my goal. Now, how are you going to get there? And what are you going to do about it?
Is it good? And is it realistic?
Yes.
I always ask financial advisors as to what age do you have your clients live till? And, Gina answered 100, but that's important. How old do you think you're going to get? So, which means at your present age, I'm 71 today. So if I lived, my money's got to last me, and if I live to 100, which I hope to.
That'd be 29 years, Pete.
Huh?
That's 29 years if you were trying to do the math.
I was afraid of that number.
Seems so finite, doesn't it?
Yeah, it does. It really does. You know, it's a scary thing in a lot of ways, because you're facing your own mortality. But this is another thing is that you know, I don't think if I reach the age of 90, I'm going to be doing a lot of traveling. So if I'm going to be doing some traveling, it's going to be in the next 10 to 15 years. So anyway, I think financial planning, this part of the process, is very important for us.
One of the things that sort of ties into from just a graphic standpoint is what's important to you, what can you control, but it's that intersection in between where really is the thing you can focus on, because it might be important to you, but you can't do anything about it. And it might be something you control, but it doesn't matter what it is. So it's really that intersection of the two parts.
Yeah, and just to back up to that again, things that you can control and the things that matter. What is that old phrase that give me the wisdom to determine the things that I can change, and I'm not sure what the rest of it.
Because you didn't make it through all 12 steps, I think, of that program. You mainly only got to the first 2, and then you fell off because you wanted the glass of wine at the beginning.
That's right. Well, you know, and that's why don't listen to Susie Orman, or unless you're just entertained by her, because she is entertaining, or Jim Cramer, because they just don't know the things that matter to you. Let's go to the next slide.
So the first starting point is, where are you now, basically? And so start with a balance sheet, if you will. What's the net worth? I mean, these are, to a lot of people, these are really scary things in terms of terms, but really what it comes down to is, what do you have? What do you owe? And the difference is your net worth. So there's a basic accounting term there. So you have cash value in your insurance, investments, all these different items. You have your house and real estate. And a key thing that we talk a lot about in the It's Your Estate program is, how are they titled? Are they community property or otherwise? And what's the cost basis for them? When we first started doing this, I kept wondering, why am I doing that? Well, if you're not going to sell the house, okay, but you should plan for this. And therefore, what is your basis in the property? Because it gives you more choices and options to consider when you start getting into the planning part of it. Yeah, then what do you owe? Is there a mortgage, credit cards, car loans? God, I hope you don't have student loans at this age. But you know, who knows what's going on in the world. And then the difference really is, what's the difference between these two?
When I was at Long Beach State University, you know, and was talking to many of the professors, this is one of the first things, you know, that we discussed, is to create a net worth statement. And almost 95% of the individuals that we sat down and did this, and it took about a couple of hours to do, that one, they had never done it. 2 is they underestimated their own net worth. And so if you underestimate your own net worth, you know, then you're restricting yourself from spending and, you know, enjoying what you have. So your net worth is really important. You should know it. And it's kind of like going to a doctor's. You know, when you visit your doctor, they basically take your weight and your blood pressure before they do anything. This is example in the financial services industry. This is what needs to happen first.
And the other part of that becomes basically, what's your income sources? So now that you know what you have your goals and you prioritize those over here, where are you going to get money to live on? So part of it's a matter of, yes, Social Security, that probably is not going to cover all of what you need, certainly. What other items do you have? And it is important to remember that if you are married, when one of you when one of you passes away, you have the option of taking the other's Social Security. When my wife and I went through planning for where we were going, she took all of hers as early as she wanted to, and I waited until I was 70. And the guy at Social Security was talking to her and said, he's going to die first. You're going to get his money. And I thought, really, I felt bad about this and asked him, you do know that I'm here. And he said, well, statistically, am I right? Yes. Okay, then she can do whatever she wants because ultimately she's going to get your money. And that is true. And so that's something I'm aware of. Anyway, so then you have other income. We had annuities, be it real estate, pensions, and you also have an investment portfolio. And you can spend what you earn there, but you also should look at what you're going to draw down.
Yeah. People have a hard time spending principal sometimes. But let's say, for example, you have Social Security pension of $40,000 worth of income. You have $1 million net worth. $500,000 is the value of your home, and you have another $500,000 in your investment portfolio. Okay, well, you got 40,000 secure income coming from Social Security and a pension plan. Now, how much are you willing to draw down from your investment account to meet your spending needs or to meet your goals that you want to accomplish? And that's the crux as to how that investment is now structured.
This is out of Social Security, put this out a while back, and it's showing this is how much you're probably going to get from Social Security. Then you have a certain amount of income from retirements or investments or other things. But what's the income gap? And where is that money going to come from? Is it going to come from strictly the earnings of your assets, or do you need to draw them down? And that's part of what you have a plan for.
Yeah, it's not just where can I get the most income from my money, because somebody is going to lure you with anywhere from a CD that might be paying 1% to 2% to a private limited partnership that's promising 15% to 20%. So we know probably the two extremes is not where we want to be. We want to be somewhere in the middle, but how do we get there?
So one of the things in looking at this is, where do you spend money and what are you doing? So that's a big issue. We've talked a little bit about the income side. Now we look at the expenses. And a lot of times people have no clue what they actually spend. And one way that, as she said, you can sort of cheat a little bit on this. Look at your taxes. Assuming you do not cheat on your taxes, let's assume that first. Then what do you have in terms of your AGI, the adjusted gross income, is basically the money you have to live on, if you will. Then you have before taxes, then you have the taxes, and you're going to get down to an after-tax income. Then whatever you're saving, what you're doing, okay, those are all nice, but from an expense standpoint, here's a sheet. I mean, as simple as this is, or as complicated as this looks, on one side, it's what do you spend money on all these things so that you start getting a handle on it, because it's impossible to plan if you have no idea where you're going. And if you don't plan, or if you plan and you don't have a starting point, then you're going to wind up somewhere and be happy with it because it's what you got. But this is where it really helps to start going through and looking at what all you're doing.
And what I found working with people is that we're really creatures of habit. And how we spend money today is most likely how we're going to spend money in the future. It's kind of like I always ask financial advisors, can you make a spender out of a saver, or can you make a saver out of a spender? And all of them basically say, well, we can corral it a little bit, but the bottom line answer is no. So whatever your expenses are today, you're more than likely will continue that. And it's hard to change. So, and you don't need to be down to the penny. You just need to have within, I would say, $5,000 to $10,000 a year.
The other part, and some of what Pete was talking about before in terms of investments or other things, a big part of this is, what are the tax issues? Because you can have money that's coming out that is tax-free It's not going to earn as much money. So municipal bonds don't earn as much money, but they're going to come out tax-free. On the other hand, people forget that when you take money out of your, well, Social Security, you get taxed on most of that. When you take money out of your 401k or your IRA, that's taxed as ordinary income. You know, wait, what's this? Well, you didn't pay tax putting it in. The IRS would like money when you take it back out again. What are you doing with Roth conversions or other kinds of things? The other one, this California Prop 6090, if you living here in Orange County, if I want to sell my house and move into another house, if I've lived here for a long time, I have a low basis in my property tax. I can take that with me to my new location. Prop 60 allowed you to do that within the county. Prop 90 allowed you to take that into other counties if they agree. So you have to look at where you're moving and whether or not they adhere to 90, because otherwise when you buy something, your property tax is going to go up, and that's a shocker to a lot of people.
Yeah, the tax part of it is not easy, and don't think if you're making any kind of earnings or have any kind of a net worth, you need a good CPA, and because it's complicated, they don't make it easy, and you need professional help. I would not want you to do this yourself, and it can make an enormous amount of difference in the amount of return that you get on your investment. Most fee-only financial advisors will work with your CPA. I asked Gina whether or not she did taxes for her clients, and she said, no, I'm a financial advisor, but I work closely with the CPA to do exactly as to deferring of income, whether or not we need to accelerate deductions, whether or not in November or December we need to harvest some investments. And with the virus today and all the new types of laws that are coming out, you need professional help just to stay on top of it.
So then the flip side of that is what are the deductions? And again, as Pete just said, with the coronavirus as we are now, medical expenses, there's a limitation certainly on state and local taxes, SALT, in terms of how much you can take, and we are limited in terms of how much we can take for property tax and income tax and local tax against our federal tax return, where it used to be all of that was deductible. It's no longer. It's capped, I think, at $10,000. Interest is certainly deductible. Charitable contributions, as Pete just said, all the changes going on with coronavirus, the CARES Act changed charitable contributions. During 2020, if you have a mad desire to give money away, give cash, because it's 100% deductible against your adjusted gross income. Normally it's 60%, 30% if you have an appreciated asset.
Don, you have to be above your standard deduction in order to deduct charitable gifts.
No, because I can take it as a qualified charitable distribution, first of all, so it never came up in as income to me. The other part of it is if you're wiping out your entire adjusted gross income, you're way above a standard deduction. If you aren't, you didn't need to do any of this. If standard deduction takes it, then you're fine.
Yeah.
But that also assumes you want to give away that level of money. The alternate minimum tax is another issue that's been around for a long time, and occasionally it'll surprise you in terms of what's going on. So all of these are planning, but one of the things that's important is, what are you doing in the long run? What's inflation? I mean, we talk about annuities. Here's what you're going to get for the rest of your life. Okay, what's inflation? What level is it at? 2, 3%, whatever it is. What's the return on the investments that I've got getting? A lot of that is a risk tolerance. The more risk you have, you expect to have a higher return. But if it doesn't work out, you're going to lose more. And that's where all of these things are coming into play in terms of what's going on.
And by the way, and all of it is different. For example, there is a national inflation rate. Well, but if you already own your own home and you have excellent health care coverage, your inflation rate may be dramatically lower than the next individual. The return on investments, 40-year return is 12%. Should we use 12% in the plan to project future income? You may not want to. It doesn't look as bright as it did before. So you may want to use a lower assumption.
Besides that, Pete plans to live for 29 years, but on this slide it says 40 years. So he's only going to be two-thirds of the way there, assuming everything's good.
Yeah, yeah. And, you know, do you have long-term care insurance? Do we need to plan for that to make sure that you have enough liquidity? And how much would that be? So it's just a lot of things go into a plan. And once you put a plan in place, it's immediately out of date. And as you go through every year, that plan gets refined to see how you're doing. But at least you had a plan to begin with. So you have SMART goals, you have a balance sheet, and you have your spending needs. By the way, I don't know of any broker, Merrill Lynch or otherwise, that'll go through your goals and your balance sheet and your spending today. They want to go directly into the investments.
So a lot of these, as we've gone through and touched on them, the next step is going to be risk tolerance and other things, which is in the next module, week 5's module. But part of what you take a look at in Gina's case, they do a set of charts like this and tables. Here's what we think. Along the way, we had talked about best case, worst case scenarios. What are the probabilities of these things happening? And so that's the way they document theirs. It's not to review that particularly. The other side of it is education. We talked about what are your goals? What are you doing? 529 accounts are nice things if you have grandchildren, children perhaps if they're younger, grandchildren certainly in terms of being able to give money to them and what is the limit and how well you're going to be able to fund that. There are different ones nationally. You can look at California in terms of what's there. You can also look at regular investment accounts or other items for them in terms of how you can help them fund college education.
Go to the next slide.
Risk management. Pete mentioned it a moment ago. Do you have long-term care insurance? Do you have health insurance? One might argue that at 70 as I am, 71 as Pete is, do I really need life insurance? Well, if I have a policy that self-funds and gives me a good return, why don't I keep it? I don't need the liquidity of the cash value. Would I go out and buy one now? Heck no. I don't believe I would have any reason why I would want to do that. Health insurance, long-term care insurance, absolutely. One of the big things that we talk a lot about here is the umbrella liability insurance. If you're in a car accident, it isn't just how much your car insurance is, it's what your net worth is in terms of what they're going to try to go after. And that's really what an umbrella policy is about.
Yeah, and the umbrella liability policies are very cheap. They cost between $300 to $500 a year for every $1 million worth of coverage. So cover it up to your net worth, and it's money well spent. It's very low commission kind of product, and you have to have your homeowners and auto with the same insurance company. You can't have two different companies and have an umbrella policy.
We talk a lot about issues, certainly in It's Your Estate, in terms of what are the documents you need and other things. And Pete had made a comment early on that Gina is not a lawyer, but she does review these kinds of documents with her clients, recognizing how important this is in terms of, do you have a living trust? Do you have wills, healthcare directives? And certainly in the environment we're in now with COVID virus, you look at it and say, what are the issues? I mean, my wife and I sat down a month ago and said, okay, if either one of us gets very sick, what do we want to have happen to us? And we certainly have advanced healthcare directives, but really updating it for the situation that we're in today.
Yeah, it's today. I'm getting a lot of calls on living trust, and the issue is that is it flexible? The documents themselves, they're usually not the problem, but who have you chosen to be that individual who takes over when you can't? The advanced healthcare directive. I mean, you can't speak to your agent for your healthcare if you go into an emergency room today. So the only thing that they can go by is How well have you communicated with your agent for your health care? And we'll talk more about that into the medical care planning, but it becomes important. Who have you chosen and where are they? You know, it's difficult to travel today. We have one situation where the married couple, has dementia and she fell and is in the emergency room, and both the daughter and the son live on the East Coast and they can't come out, and their documents don't allow for any substitution. So it's, and you know, we're learning a lot about ventilators. I mean, you know, much more than we want to know, maybe, you know, so it's really important to have those discussions today.
The other thing in going through, like on an investment account or something else, is do you have a beneficiary designation? Where do you want the money to go? Do you want it to go to your family? Do you want it to go to charity? Probably not wanting to put it into the trust, but where are these things going? But a real key issue with beneficiary designations is they override a will or a trust. So if you name someone, you named your spouse is going to get the money, even if you divorced 15 years ago. That person is still going to get it because that's the name on the beneficiary designation. It probably does not say spouse. Yeah. It says the person's name.
Yeah, and highly recommend that you get a copy of your beneficiary designations to see whether or not whom you have named. And it's also highly recommended to name a contingent individual. In the event that your main individual that you want to leave the money to is not alive at your death, who else do you want it to go to? And if it's left blank, then it goes through probate. So it's not something that you want to do today, especially with the virus. So it's really good idea. Get a photocopy of your beneficiary designation forms and put it with your estate plan and your financial plan.
Thank you.
Hey, we did it.
We did it.
Yeah, thank you everybody for listening in. Make sure that if you have questions, let us know what you liked or disliked or what you want to know more of. And hopefully you'll stay tuned and watch next week. Gina will be back and much better looking than either one of us and much smarter. And we'll be talking about investments, risk tolerance, and asset allocation and diversification.
Thank you very much.
Thank you. Bye-bye.